I can barely turn on social media, turn on the radio in my car, or walk out of my house into my neighborhood where everyone knows that I work in lending without having 30 people asking or posting about interest rates. Something changed last week. Interest rates are the talk of the town, so I wanted to sit down with one of the smartest financial people that I know, Molly, and she is going to tell us all about what's going on with interest rates right now because there is a lot of confusion in the marketplace.
Hot topic. And as a lender, we field these questions all the time. People will ask or inform us, what's happening with rates, where are rates moving, or I heard rates went down. We have to lay a little bit of foundation and start to define, well, rates went down. Well, down since when? And like, what are they thinking about with interest rates? Because so much of the media will talk about interest rates in relationship to the Federal Reserve Board, who sets policy with interest rates. They set the Fed funds rate that affects prime rate. Prime rate's been at 8.5% at the time of this conversation for a while, but mortgage interest rates have moved lower. And for example, even though we know the Federal Reserve Board, their next meeting is set to meet in September, likely they may adjust interest rates. We've already seen a move lower in the 30-year fixed mortgage interest rate. The mortgage rates are affected by a number of factors. We had a pretty big move on Friday, August 2nd, due to a jobs report. Now, when clients ask me if they're looking at purchasing or refinancing, I like to give them the information directly. And so I'll show different public sites where you can watch and monitor interest rates. And then I'll go beyond that and show what are some of the levers that can affect those interest rate offerings. So they're able to discern more clearly, how that rate is comprised for them specifically versus feeling like I'm blowing smoke or someone telling me the truth and what is the reality of what I see, the flashy rates on the internet. So if you would, Matt, I'd love to share with you one of the sites that I use. It's such a great place, mortgagenewsdaily.com. And you'll see I have highlighted here the third tab. I'm already in it. And in this mortgage rate, we can see that this is the 30-year fixed mortgage rate. You can see a graph on what has been happening with these trends over time. You may even recognize some of the volatility. Well, look here. Oh my goodness, November 2023 compared to today, we're in August 2024. We've had a pretty big move. You could see just in the past couple of days, we've had a pretty big move. Well, guess what? During this time, in these last couple of days, the Federal Reserve Board has not moved their benchmark rate, the Fed funds rate, but mortgage rates have adjusted. Now, if we move lower into the site, it gives us information up until, you can see today it's posting the average 30-year fixed interest rate, 6.52%. You'll see over here that it's moved up since yesterday. And beyond that, you'll see the daily trends. Now, what's so interesting to note is there has to be a method for calculating interest rates. And so how this works, it's based on an owner-occupied home, 30-year fixed rate mortgage, 25% down, 780 credit score. Well, that doesn't fit every single buyer or refinance or home type. So Matt, I go beyond that and I'll show my clients, well, what are some of the adjusters? Okay, so this is just Fannie Mae's loan level price adjustment document. Anybody can see this. Fannie Mae and Freddie Mac are the agencies of the mortgage world, and they tell us the rules we follow. And in this chart, you'll see first column, it says credit score. Well, there's that 780 plus credit score. You may also notice that every 20 points moving lower, that credit score can influence the cost to the rate as we move to the right of this chart. Now, you'll also see it moving right, each column where it has a loan to value. So what does this mean? It just means the amount we're borrowing after down payment is made. So this first column, for borrowing a client 30% of the price or value of that home after down payment or equity. Well, let's move closer to the middle at a 20% down payment. So let's say our client is putting 20% down, or they're refinancing with 20% equity, and they have a 780 credit score. Boom, here we go. So you'll notice at 20% down, there's a cost or a hit of an additional 0.375% basis point. It affects the price. So here's where it gets confusing. It's not a direct add to the rate. It affects the price or cost to take the rate. Now you'll notice here at 25% down, there's no hit or addition. And you can see for yourself that as we move lower in credit score or lower in down payment, those adjustments start to pop up a little bit. And I'll add one fact. You may notice over here, lower credit score, lower down payment. This would represent 3% down. The impact to interest rate is 1.5%, like cost or hit. Well, if you put 20% down in this example, it's a 2.25% cost or hit. There was a very important change legislatively made by the Biden administration in 2003. They, I think it was considered like equitable cost. And so they started to shift where people that had lower risk credit profiles, they would take on more of that cost than somebody that had a higher risk credit profile. So it doesn't follow the old formula that just, higher risk, higher hit. There is some blending of that. But then here's where it gets really interesting. So Matt, let's say our borrower wants to buy a home, 25% down, great credit right here, no hit. But that home is a condominium. Oh, here we go. Here's condo. We got to move down to the second chart. And now you'll see there is going to be an adjustment or hit to that cost. Let's say it's a second home or an investment property and a condominium. Well, now we have to start layering these hits to the interest rate. So people will wonder, why does investment properties or second homes carry a higher rate? This is why. That cost to take the rate has been impacted. So now when we see that 30-year fixed rate trend line, we still have to make the adjustments for the specific circumstance.
So Molly, two questions come to mind. First, is this your company that plays by these rules, these Fannie Freddie rules, or is this in essence like mortgage companies in general?
Great question. So it's mortgage companies in general. And here's how it works. So Fannie Mae, Freddie Mac, they're the agencies that comprise or make the rules for conventional financing. Now, when someone takes out a conventional loan, it follows these rules. And when that loan closes, that loan becomes a securitizable asset. It's a security. And it's a security because it's followed those rules. So it allows that security to be actually bought and sold in the secondary market. Now we're getting deep. It gets bought and sold in the secondary market. A consumer or that borrower doesn't get to choose what mortgage company or servicer has their loan because it can be bought and sold as a security on the secondary market. That same thing holds true if it's government. Let's say it's under HUD umbrella. It's an FHA loan, a VA loan, or a USDA loan. Once those close, they followed specific rules. It becomes a securitizable asset. It can be bought and sold on the secondary market, but all the rules are the same. In addition to the rules of the loan, those price structures are the same for each of those loan types. It does not matter the institution offering the conventional loan or offering the FHA loan.
I love that. So, we're in this position now where there has been a lot of interest rate news, and there's a lot of people in the mortgage industry who had what I would call like a tough 2 years, where after it was easy to find customers, now it had become harder. So now every person with a mortgage license is calling every human they know with a mortgage to see if they could refinance them. Is there anything that consumers should watch out for or worry about?
Well, like in any industry, we're not all created equal. And in mortgage, there's been a huge shift to big tech. And there are some really important differences with that big tech platform. A lot of times, that big tech will install a loan officer. It's more like a telemarketer. Their job is to call who's ever in that next call prompt, call queue, etc. And they're following a script, they're following a process. And usually you'll have someone that's maybe not as experienced, newer in that seat. It's really different than how we are organized at Treadstone Neighborhood Loans. The skill set is different. Most of us have been doing this for a very long time, have layers and layers of experience over years. And even the philosophy and how we serve that client is different. I'll tell you, if it's easy for anybody. But when it's complex, very few can usually solve or work or play in that complex playground. And it's probably an area that I've learned to excel at just because I've been doing it so long. I've seen a lot of puzzles, and it actually makes it a lot of fun to kind of build in those layers of complexity, find cool solutions, help our clients be strategic in their solutions, not only through pricing, like I showed you, but structure as well.
If a client wanted to protect themselves from getting, hundreds of unsolicited phone calls, texts from, reputable and not so reputable lenders, how could they avoid some of those calls ahead of time? Knowing that they might want to
Ugh,
refinance in the next year or two, but maybe they want to wait for their lender to call them with an update on when it's time versus, getting a call from someone who's been in the business for 6 weeks.
optoutprescreen.com. It's a solution for consumers that can register your name, your phone number, your address, and your email and go on a 5-year stop all solicitations list. Now, it doesn't always stop every solicitation, but the bulk of it does. Credit bureaus will sell a consumer's information to whoever's buying it. And we've had or heard of clients having 100 people call them in one day. The solicitations are so intense. Anytime someone moves, well, guess what? That new recording is a public record and counties can sell that information. So optoutprescreen.com is a great way to save the earth, reduce mail, and the annoyance of tons of solicitations.